Okay. Rolling.
What a wanker. Starts mixing cocktails.
You know what? Just leave it. It's good ambiance. Nobody's going to care.
Yeah.
Let's get it. Let's do it. Hit it.
It's Friday, September 8th, 2023, episode 221. I'm Patrick Seresna.
And I'm Kevin Muir. This week, John Davi, founder of Astoria Portfolio Advisors, joins us to talk about his firm's intersection of quant and macro and what he sees ahead for the markets. Then it's time for Patrick to explain to us why technical analysis is not just astrology for adults in talking charts.
We end with no stupid questions and skin in the game. And folks, we might even drink some beers along the way. So, Lena, hop on. What beer are Kevin and I drinking this week?
You guys are drinking Suntory beer. And Suntory insists on using only 100% natural underground water for our beer and the new category of beer flavored beverages produced in Japan. They had a whole long description, but you can read that for yourself at suntory.com.
Well, there you go. Yeah,
it's lucky when I got the sponsorship that they actually didn't insist that we read the whole thing, but it was tough. There might be some language barriers that I had when I was there, but that's pretty good. Actually,
you know
almost it tastes like a Canadian beer, don't you think?
Yeah, the Japanese make great beer. This is a fact.
It tastes Canadian, and you're like, yep, the Japanese make great beer. All right,
give us some side
effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include option chain pain, sailing the Morgan whale, and podcast infidelity.
Ooh.
Yeah, that's definitely one you suffer from, Patrick.
Yeah, no, that's fact. All right. Let's get to the interview.
It's our great pleasure to welcome to the show John Davi. He is the CEO and CIO of Astoria Portfolio Advisors. John, thanks for joining us.
Thanks for having me on, guys.
I would love to get to know you a little bit better. I was listening to one of your other podcasts. You were mentioning that your folks are from Italy. Did you grow up in Astoria? Like, was that where the name came from? I'd love to hear a little bit more from you about your background.
Sure. So, my parents were born in Sicily, Italy. Came to this country when they were, 13 and 19. I was born and raised in Astoria, Queens, which is only 5 miles from Manhattan. It was a great lesson because, in the late 70s, property in Manhattan, started to elevate and go higher. So there was like a natural rotation where then people started buying property in Queens and Brooklyn. And it's kind of similarities to like the value trade, which if you owned that property in Brooklyn, Queens, 20, 30 years later, these were like deeply discounted, assets. And then eventually they became like, growth stocks and momentum stocks. So now basically parts of Queens and Brooklyn are virtually unaffordable. So there's a lot of similarities between how I was raised and grew up to like, kind of invest in. I went to college at Hofstra University and I started interning in Merrill Lynch's quant derivative research group. And there was a gentleman there.
What year was that? When was that?
1999.
Okay, so you're coming just at the end of the dot-com bubble. And was that group relatively new at the time?
No, it was not new. I mean, Merrill Lynch, like, strategy, research, actually there was a lot of affluent people that worked there that wound up, becoming big, reputable people. So my boss, Steve Kim, he invented the Greenspan put. He was very well known for that. There was other people in there, Richard Bernstein, David Rosenberg, Satya Pradyuman. There was a lot of came from, the quant research strategy group. I sat next to Savita Subramanian, who's now like the head of strategy at Merrill Lynch. So it was a great place to learn. And I was a young intern in the late 90s. When I first started, I remember internet stocks were going up, 300, 400, 500% a year. I mean, the NASDAQ index went up something like, I think, 120%, like just the actual index. The the year I started. So it was a great time to be
Right.
entering the industry.
Now, can I ask how you got that job? Did you focus on computers? Like, what was kind of your in?
I was attending college, and there was Diane Garnick, who's one of the quant analysts in the Merrill Lynch research group, came, gave a presentation. I took her business card. I sent her an email. She's like, "Why don't you come in for an interview?" And went in for an interview, and I told him, "Look, I'll do whatever it takes to get an internship." And I worked a lot of hours. I went to school 2 days a week, and then I interned 3 days a week, all day, all night. And I loved working with data. I loved working with indices, and it was a great place to learn. I always had a big thirst for like data and knowledge and insight. So
So you're ahead of your time that way. Okay, so how long did you stay at Merrill Lynch?
I was there in total for 10 years.
And during
So
that
8 years.
during that time, you were basically the same role, the same group.
Yeah, I was 8 years in the quant derivative research group, and my responsibility was doing like Delta One research. So indices, ETFs, futures, um, anything like sort of synthetic that where it was like Delta One exposure. We really did a lot of kind of cutting edge, groundbreaking work on like putting together like swap baskets. I mean, back then like EEM wasn't around, right? So you had to build like a swap basket that would have ADRs and futures and some ETFs to track MSCI emerging markets. And we'd work with the traders and large institutional clients. We did a lot of good work there. We put together like model portfolios that the retail and wealth management side would utilize. Um, we would do a lot of work on like Russell rebalance. So when stocks get added to the index and when they get deleted, they exhibit a certain price behavior, which a lot of hedge funds would use in order to like arbitrage. So I did that for 8 years of research, and then I went to the actual trading floor, and I spent a couple of years there as a strategist. And then after that, I moved to Morgan Stanley, still in the trading floor, and I was doing ETF content and research. I did that for 8 years before I left to start
Yeah. What
Astoria.
was that like moving to that firm in terms of the change in culture? Were they similar, or did you find a big difference?
Both were excellent cultures and both excellent places to work. Merrill Lynch, when I first started, there were like 1,000 NASDAQ traders, right? So one trader would trade two stocks. So like our trader flow was massive. Um, if you think about that for a second, like, you'd hire one guy to trade two different NASDAQ stocks, 1,000 NASDAQ trade. I mean,
Yeah.
it was really archaic. It was a sign of the times. There's less computers. I think Morgan Stanley was, more into investment banking, Merrill Lynch more into wealth management. Um, two excellent places to work. I've got nothing bad to say about either one of them.
And so from there, you do that for another 8 years. And what is the impetus that makes you go and say, I want to do this for myself?
Well, I always had an itch to kind of, join the buy side. And I always thought I would, kind of start a business. So it was a way to kind of kill two birds with one stone. So
All right. And you said that once I heard you say you're the intersection of macro and quant. Could you explain what that is and kind of maybe tell us a little bit more about Astoria Portfolio Advisors?
yeah, so we are an asset management company. We manage money on behalf of other financial advisors that are looking to kind of outsource the portfolio management and trade and executions. Um, so we come with a range of solutions, whether it's kind of quantitative, stock portfolios, multi-asset ETF portfolios. So the firm's been around for 7 years. We manage and oversee about 1.4 billion in total assets. Um, I would say what I find is some of my peers are just pure quant, and all they're going to do is talk about value and size, and when that works, or just be long momentum, and as their primary factor that they're looking to harvest. Whereas other guys just very macro and just make kind of bets in their portfolio based on FX rates, equities. But what we try and do is like be the intersection of the two, where we're kind of marrying both. And I think that's what we've done well, and clients appreciate it. So, essentially what we're trying to do is like, okay, identify where you are in the macro cycle. And everyone I'm sure can identify, but some are better than others. And then once you identify where you are in the macro cycle, using the factor that can kind of best express that specific stage in a cycle, and I'll give you an example in a second. So that's what we're looking to do. And then like the third wrinkle that we would use is like we are going to use liquid alts to kind of dampen our portfolio volatility to try and like capture like an asymmetric up down capture ratio. So people will come to me and say, well, we use alts, and they'll talk about high yield bonds or commercial real estate or some type of like illiquid fixed income like high yield debt as like an alternative or emerging market debt. But for us, like our alternatives are going to be very low correlated, like or inversely correlated, ideally. And that sort of like inclusion of alternative, which you can look at that as if you don't have a risk off event, will be wasted premium, and you'll have a drag. So maybe in a year like this year, it's difficult, but it comes in handy when you get these like sell-offs, and there has been some decent sell-offs in the last 7 years. So it does add to your cumulative kind of outperformance. I think like our firm, 2 years ago, had this big view and vantage point on inflation, and that really kind of helped us, because I think like we were so early with the inflation call, like in June of 2020, COVID was still very much, escalate, and we had seen all this stimulus being thrown out. And I don't know about you guys, but in my economics 101 class, they taught me that if you restrict supply, you increase demand, prices go up. So
Yeah.
we had this foresight to say, okay, we thought inflation would be a problem, and we went ahead and launched like an inflation sensitive strategy to kind of hedge that inflation risk. And this was when CPI was 2 on its way to 9. I think we're good at identifying the business cycle, the macro cycle, and then like how to build a portfolio around.
All right. I'd love to know, in terms of your confidence, what gave you that confidence in 2020 when a lot of people were, talking about the disinflation that we'd experienced for the last 20 years and couldn't imagine that ever changing? What gave you the confidence to say, oh no, this time is different?
Well, if you looked at the money supply, it was going parabolic. It like supply chains were shut, like they literally shut the world down. So I had never seen, where, supply chains were just stopped and you couldn't really, kind of, it was just such a bottleneck, right? You couldn't get food, you
Okay.
couldn't get, cars and, used car prices. Like it just made all the sense in the world, and especially because economics 101, as I mentioned, you restrict supply and then you just stimulate the world and give everyone free money. I think in '08, like all that bail, the bail money from the banks, like that went to the banks, but it didn't really make it to the actual economy, whereas this time the government just cut out checks directly to individuals. So it
Right.
wasn't like a PhD moment. Like you had to have like a PhD to figure that out from our standpoint. So, but I would also say principally like, we've always hedged inflation risk. And here's my point, guys, is like, whether inflation's 2% a year, which it was for a while, or 9, like 2% a year, and we tell people to invest for the long run, like it does accumulate. So we've always owned like real assets and things like gold equities in our ETF portfolios because, we just think you should always like, you don't try and time your car insurance, your house insurance, like you drive your car, you got insurance. Like we think all portfolios should own inflation insurance, particularly because it's a non-zero amount every year.
Got it. Now, not only should they own it kind of all the time, because you need, when you need it most, if you haven't got it, then you're going to be stuck. But you also think that that we've changed and we're in a sticky moment of inflation and that we could continue to surprise on the upside. I'd love to hear why you think that.
Well, we are seeing inflation come down, so there's some pockets of disinflation. But I think like, I don't know about you, but I have not yet paid lower prices for anything that I bought at the supermarket. Pizza, bagels. There's been no disinflation, right? So I still think that you've got you know, this imbalance between like supply chains, still disrupted. They're better than they were 2 years ago, but you are seeing companies look to like kind of onshore and reshore. And those things don't take, they take years and years in order to kind of build a new manufacturing plant. And, by the way, if demand is there and it's still there, then I think prices are going to stay elevated. So it's our view that rates will stay higher, real rates will be higher than what is currently priced in. Like we just don't buy what the bond market is saying that there'll be 5 rate cuts next year. I mean, listen, if there's some like some significant event where markets and economy go into a free fall, like like the Fed will provide liquidity as they've historically done. But we also aren't expecting like some massive recession, like an '08 recession or like a COVID recession. In fact, if anything, it'll be more of like this roll-in moderate recession where pockets of the economy are impacted. And technically speaking, when I started my career, like it was always 2 quarters of negative GDP growth was a recession, which we did get that last year. But it felt like, the goalposts were being moved a little bit. But, from our vantage point, like last year, you started seeing the recession, hit longer duration assets, longer duration bonds, unprofitable tech stocks. Um, and obviously we've rebounded this year, but it just could look this recession very different from other recessions is the point where it's not like all at once, all sectors of the economy. Perhaps next year it's more of like the real estate market because mortgage mortgage rates went up significantly and commercial real estate's in a little bit of a trouble next year. So that's the kind of recession we expect to happen, where it's not like some broad base all at once where the S&P falls 40%, in 2-3 months like it did in COVID, where it's like other pockets are being impacted.
So how do you, as a portfolio manager, stick handle through that? What's the keys?
Well, we follow a set of macro indicators, and we update these indicators, weekly to identify where there's, consistencies and consistencies. And we definitely have seen, things like labor being stronger than normal, manufacturing being weaker, yield curve being, inverted for a very long period of time. I think like in the US, it's all being held together by strong labor market and a strong consumer. But even for that, we're starting to see some pockets of weakening, on both fronts. So looking at the market this year, like I don't get overly excited when I see like the S&P being really carried by a small select number of stocks. It was nice to see this summer, June, July type to see like a broader rotation across other pockets of the market. Um, but sentiment has, kind of cooled down significantly in the last, few weeks. So, we'll see. I mean, I think if there's a few indicators you're going to really look for on the macro front, it's going to be, jobless claims, unemployment and consumer health. And then, earnings. Earnings is a big thing from what we watch. And I think that there's, some significant risk out there still. So we'll see. I mean, I think like if the economy starts to go because consumers are laid off and they run out of money and they've had 2 years of high inflation prices, then we'll see that, kind of result in weaker pockets of equities.
Now, one of the things I think that a lot of people have been surprised about is the fact that we've had interest rates go higher, and in fact, real rates have gone a lot higher. And yet the PE is expanded on the S&P, which is counterintuitive to what most people would have predicted. Like if you asked people a year ago, okay, like US 10-year TIPS yields are going to be 2% up from 1% or whatever they were a year ago. What's the PE? Most people would say it would be lower, yet here we are and it's higher. Is that all a function of this AI, and would you call it a bubble? And do you have any kind of insights into that apparent paradox?
Well, we think tech is a sector that it's really tough to be underweight, right? Because there's just, they're revolutionizing how things are being done, whether it's, work, social life. So it's really tough to be weight structurally in portfolios, technology. I think like I think most of the AI, it's reflected in these stock prices. So, and some of these are like really fantastic companies like Apple. We just think that this point in time, like maybe you ought to own less of some of these stocks and more of other stocks. Meaning like, our approach to, we've been running these quantitative stock portfolios at Astoria for 7 years. And prior to that, I did it on the sell side. And we had always used equal weight just because we thought that made sense. And I think particularly now, you want to use equal weight over market cap weight. So I'll just leave it at that.
Okay, and one of the other things that I've heard you talk about is the fact that you think that overseas or non-US stocks might offer a lot more value. Can you expand on that?
Yeah. So, that's been a call that, I think people have been asking for, wishing for, hoping for, and it's been difficult. But, I would say this year is one where for a good portion of this year, developed Europe, Japan, had, as much upside as like the broader, equally weighted S&P. Whereas, I mean, just S&P X Tech, let's say, or if you use like an equally weighted, ETF, like an RSP, like, so it told us that I think Europe was a little bit further behind the inflation cycle, the interest rate cycle. Europe is a play on global growth, and Japan. So if we weren't going into a recession, it made sense to kind of own derivatives on, U.S. growth, or global growth. So Japan and Europe have had, pretty decent years. Um, Valuation isn't an only reason to buy a security, but, it's hard to like not acknowledge that Europe and Japan are just so much cheaper than US. So we're global, like we own diversified global exposures via factors. So we always own in our standard multi-asset ETF models, like both Europe, Japan, EM, and US. I mean, obviously some years are better than others to want to tilt towards US, but I think, what we have been encouraging advisors to do is to like open up your horizons and thinking that there's other opportunities outside of just 7 stocks in the US.
So you talked about different factors and different types of strategies, and one of the strategies that you kind of focus on is a quality strategy. Could you explain to us what that is and how it works?
Yeah, so we've running multi-asset portfolios and quantitative stock portfolios. I would say that the one factor that tends to be the most persistent. I mean, value, small, momentum, quality, profitability. These are all persistent, pervasive, robust factors. However, some work more consistently. Some, like quality, is consistent. I would say more consistent. Some, like momentum, is just you'll have big up years, but then also your down years will also happen. So your risk adjusted returns may be lower than, let's say, quality. Value is very fickle. Small caps have to work, in a very specific part of the cycle. The quality is something that our advisors have grown to like because it's easy to understand. You screen for stocks that have, high ROE, high ROA, good free cash flow, sustainable dividends, not a lot of debt to equity. So in our quantitative stock portfolios that we've been running for the last 7 years, that's what we'll do is like start with like a large, broad universe of stocks in the U.S., 1,000, and then ultimately filter down so they get, whether it's 50 or 100 of the highest quality stocks, and then sector optimize. So that's what our strategy, has done, and I think clients get it right. It's like large cap blue chips type stocks, but the key is, kind of equally weighted because, given like market cap weight and at this point, given how big, Nvidia, Apple has become, is very difficult to suggest now, given the run up in prices and valuations.
I'd love to hear how you deal with the underperformance that occurs in periods when you have those like 7 largest stocks exploding higher, and that kind of, like it's almost career risk. And we can intellectualize it and say it's dumb to buy these 7 stocks at these prices because over the long run it's not going to work. But unfortunately, over the kind of next quarter or next year, you're underperforming. So how do you deal with that?
Yeah, and I they talk about career risk a lot, and I think that's like in the value camp. If you're gonna be like, I'm a deep value guy intellectually, it should work, it will work, hope and dream that your day comes. I think quality is going to be more persistent and more consistent on a relative basis. But yeah, like being, but that's why I think in our ETF models, multi-asset ones, like, you can own some value ETFs, some quality, some small cap, and then historically the research shows when you own all these factors in a portfolio, you harvest them for the long run, historically you've been able to get higher up on the fishing frontier. So we'll never just say like, okay, this year we're going to be long, the momentum ETF or the growth ETF, because, we just have a view that AI is going to like be in vogue. Um, again, like these companies didn't create AI, this year. So it's really puzzling to see like the reaction. And I think like as you get later in the cycle, you start to see more and more crowding. And if anything, that kind of confirms, having like a more cautious tilt to your portfolio. And that doesn't mean to like you've got to be underweight equities, overweight bonds, and all. That could just be like, hey, you know what? Instead of owning the S&P 500 index, maybe you spread your risk and you diversify away into, let's say, an equally weighted approach, or you own some international securities which are further behind the inflation cycle and give you some more potential upside because of cheaper valuations. These are all things that like I wouldn't say like, okay, we want to avoid career risk. Um, so we're just going to be long, the S&P ETF.
Got it. You've mentioned the equal weight numerous times. Was there something in your development like that triggered you into feeling that was definitely the way to go? I know I feel that way. I'm always shocked when you look at the papers and you realize that over the long run, equal weights beat market cap weights, and you understand if you're CalPERS why you're not investing in equal weight, because you can't. But I'm always shocked that more individual and smaller kind of institutions don't do equal weight, because as long as you can handle the periods of underperformance, it generally works. So I was just wondering, what point did you come to that realization? And I would just love to hear kind of your journey in terms of embracing equal weight so much.
So good question. I think like if you look historically, like the S&P equally weighted index, which goes back to like 1999, it's produced like a CAGR of like 8.9%, whereas the actual S&P index, the CAGR is about 5. So pretty meaningful pickup in CAGR. So that's just the historically past performance on dig of future results. But now certain years, obviously this year being one of them, mega cap and market cap weight is going to outperform equal weight, has been. Will it persist? Will it revert? So you may get acute periods where one may do better than the other, but that's just part of any strategy where you just have to be long it and be persistent. I think just like any other strategy, you got to be patient and have like a long time horizon, which I know goes against most humans and what people are comfortable. But we have just always felt like it made sense for us to kind of equally weight as a risk mitigation tool, and then let the quant screen kind of pick and choose, who wins, as opposed to like if you go with market cap weight, you're putting more weight on a few select stocks. So just intuitively, I think equally weighting your exposure make a lot of sense.
All right, John, let's finish up with our questions that we love to ask all of our guests. Let's start with your favorite investment book.
I like Howard Marks, The Most Important Thing. I think one thing that as a guy that's like pretty deep in credit and bonds, there's never any charts or graphs or Greeks, convexity. It's always kind of like simple. I like how he writes the bullet points, double spacing. Like it's kind of how I always I try and keep my points succinct, couple bullet points. So I've just learned a lot about investing from him, and the most important thing is I think a good explanation or good title for like what is the most important thing when it comes to investing and risk management. So I quite like that book a lot.
That's a great one. That's actually, I don't think we've had anyone ever say that one. So it's good to get something new there. There's the famous Canadian strategist, Don Cox, and he always used to say that you should invest but based on what's on page 1 today, but what's on page 14 on its way to page 1 tomorrow. Do you have a Don Cox kind of idea for us?
Yeah, I think, deglobalization, what are the impact of, moving supply chains away from, kind of Asia, the the strained relationship between U.S. and China, what that means for portfolios, what that means for investing in emerging markets. I think these are complicated issues that are going to be with us for a very long period of time. But I would rather be earlier than later in general when it comes to investing. So we tend to think about these issues, um, which is part of the reason why we've had this inflation view and vantage point, because I don't think that these are going to go away anytime soon. So I think just that whole overseas relationship and what that means for inflation, is something that you want to put on your front burner, as opposed to just being obsessed about, AI and, what that's going to mean for investing in tech stocks in the next quarter or two.
Speaking of AI, we're going to now do the question that the previous guest asked you, and here we'll just play it, and we'll see what your answer is.
Yeah, I think something topical should be fun. So I think I was going to go with, if you're an investment professional, is AI going to change your investment process? Has it already? If so, how?
So, John, has AI changed your investment process at all?
I would say you need to have a combination of humans plus automated processes in order to really comb through. It's the best. Mixing humans and computers is the best of both worlds. We've been running quant screens, for 25 years. I mean, a human can't run these, codes that we run because it's too much data, but you still need people overseeing the codes and checking outliers, any data issues. We would never just click a button, have a computer run a proposed trade file and just automatically go to the street. We're always going to have to combine it. I think AI is great. I think it should take as much human emotions out as much as possible, but you just can't eliminate the human emotions when it comes to investing.
Okay. Now, John, I'm going to put you on the spot because you're going to have to ask the question for the next guest. And it doesn't need to be something so profound. Like someone asked, what if you had to eat one food for the rest of your life, what would it be? So I'd love to hear what you'd like me to ask next week's guest.
You had to pick one country to invest in for the next 10 years, not your home country. So if you're a U.S. guest, not the U.S., but what country would you pick and why?
Oh, that's awesome. That's a great question. All right. The final question for you is, what would you tell somebody that's interested in getting into our business today, a young person graduating from university or college or whatever? What advice would you give them?
I give the same advice as what my mentor gave me, which is work really hard, read as much as you humanly can. And, there's always going to be, he didn't tell me this, but there's always going to be someone smarter than you and maybe more skills. But if you've got the will and you've got the passion, that's as good as being smarter than the next guy. So have passion, don't do it for money.
Okay, before we finish up here, I see that you are recognized by Bloomberg as an ETF master chef. Is this an official designation?
I've been working, in 99, 2000, we were putting together these ETF databases and correlation matrices. So just been around the ecosystem for a very long period of time.
Oh, that's great. All right. So, John, why don't you tell people that are interested in learning more about you and your firm, where they can reach you and where they can kind of find more information out?
Sure. So, AstoriaAdvisors.com. We're on Twitter at Astoria Advisors or on LinkedIn. And you feel free to reach out if you have any questions or any comments. We'd love to hear from you.
Terrific. Well, thanks for your time, John. Nice to meet you.
Thank you so much.
All right, Patrick, it's time for Talking Charts. What do you got?
It is. Well, it's been a while. It's been a month.
It has been a while.
You know what? And,
that's right, because you were off. You were lollygagging or doing whatever you were doing, so it's been a whole month.
Absolutely. I had a great time out in Croatia and everything, but it's time to get back to work. Well, anyway, so let's start off, though, talking about, let's just quickly say what were the three things that we were watching a month ago, and that was whether the equity markets were topping, and the answer is yes. the FOMC, or at least we'll talk more about that on the charts. The FOMC minutes, which were nothing really. And did you take away anything from Jackson Hole or the BRICS, or was it all nothing burger?
It was a nothing burger, just like I said it was going to be.
Yeah.
Did. And all those gold bugs are very upset that there was no gold-backed currency.
Unbelievable.
Well, you know what, though? They should really tune into your podcast infidelity show to find out about those things.
Okay, let's talk about the top 3 things to watch in the next 2 weeks. We have later this month the global PMIs. It's going to be really interesting to see whether we continue to see the global economic activity continuing to slow. Then we have this coming week the inflation numbers, and I think a lot of eyes are going to be on that because obviously all of the central bank statements. We have the FOMC meeting coming up, the ECB meeting, and the Bank of Japan meeting all coming up. Those are the top 3 things to watch. Which ones are the ones that's on your mind?
I think you got number 1 and 2 wrong. I think inflation numbers should be top of it.
Really?
Central banks, it's pretty well known. FOMC is going to pause. I don't know about the ECB and BOJ. They're just going to take their time doing it. It's the inflation that matters, Patrick.
No, well, you know what? I just figured 3 central banks together could be more than.
Well, that's true. Now, after I said that, you watch, something's going to happen. It's going to be a surprise. Did you see Poland surprise the markets?
Yeah,
they were expecting a cut of 25. It was actually a cut of 75.
Yeah,
which is it's actually very interesting, Patrick, because if you think about it, think back to like a year ago when central banks were surprising. Which way were they surprising?
It's upside,
right? And now we're getting surprises the other way. It's just like a little bit of the change in kind of the global economy that we're seeing. That now all of a sudden we're getting central banks saying, "Oh no, we got to panic. We got to cut rates."
Yeah. Anyway, so let's talk some charts. What I want to do is start off just with the S&P. This is the futures on the December contract, because otherwise the contract roll on the continuous looks like there's a gap. But we were talking in our episode out in August as to whether or not the markets have topped. And obviously, the month of August saw a pretty clean market correction, this 300-point drop, and we got the bounce. And the bounce so far has been somewhat weak, and it's certainly rolling over. But what's interesting about the rollover of the markets is while it doesn't look too ugly on the S&P or the NASDAQ, when you go to the Russell, and you see the Russell is right back down to August lows. And then you take the S&P 500 equal weight, and that's almost given back everything back to the August low. And the breadth of the market is substantially deteriorating. I mean, we're just using one of my favorite ones, just looking at the percentage of stocks above their 50-day moving averages. We were at typical peak highs in July going into August, hitting 80 to 83%. Just like that, we wiped down to 36%. Pretty much 2/3 of stocks on the New York Stock Exchange are in a downtrend now. And so while the S&P and the NASDAQ have held up, things underneath the hood are pretty weak. And to me, that's a notch for the bears for there to be a little bit more continuation selling. My only thought, Kevin, and this is the part that I think a lot about, because recall back, we talk a lot in our past episodes about how 2007 played out. The fact, there was subprime blowing up right and left, and still in October of 2007, the market managed to still make a higher high, and oil was ripping, from 50 to 150 going into 2008. And I kind of, even though things look like they're slowing down and things are rolling over, I'm trying to, something just doesn't feel right about being so bearish, thinking it's just going to all crash from here. I think the market may shock everyone with a couple of serious whipsaw fakeouts, just to like fake out the bears, fake out the bulls, and create maximum confusion and pain. What's your thought on that?
Well, I do like it, Patrick, the idea that it's going to cause the pain to the most people and that it's going to be neither the Bulls nor the Bears will win, which is kind of what I said for the whole year. But I would say that I was actually wrong. The Bulls were correct, but I think they were incorrect for the wrong reason. To me, it's increasingly feeling like it's a tale of two markets. And I know everyone talks about the Mag 7 and they speak about how it increasingly dominates the stock indexes. But I just look at the last couple of days and we saw the Mag 7 get bid whenever there was a dip. And yet the actual, the small cap, which is what I like to watch, it got sold and it's not doing that well. So I'm with you that if you took out those other kind of, those 7 big stocks and asked, what is the average stock doing? It's not doing that great.
No, it's awful, actually.
Let's pull up the, can you pull up the IWM for us? Let's have a look at it.
Yeah. Well, that's why I had the Russell. Here, I'll just put up the Russell. This is a rut.
Okay.
But
look at that. That's tough to say.
It's not just even the chop for the year, but if you zoom out and look at 2022, added to this mix. The thing is that we never meaningfully rebounded the 2022 bear market.
Yes, that's a great point, Patrick. This is still in a bear market.
Yes, it is. The Russell is still in a very clear bear market. It was only the NASDAQ and then subsequently the S&P being market cap weighted that had that huge a bounce based on the Magnificent Seven.
Can you do the RSP, the equal weight? Let's have a look at that.
Yeah.
What that looks like.
It's not as bad as the Russell.
It's not as bad, but it's still choppy. It's not really like you wouldn't say, "Oh, this has been a terrific year."
Oh yeah, no. It's really been a story of did you own the FANGs or the Magnificent Seven, and what's interesting is that. Those stocks are starting to get mixed. Like, take a look at Apple after the news from China. And it really feels like this is not going to be participating in the upside anymore. Like, I'm not trying to imply that this is all downside from here, but this chart has really lost all of that momentum that it had throughout the 6 months of the start of the year. And odds are that reasonable that the high of the year is in for Apple.
What about NVIDIA? I was trading that a little today. It felt heavy as well.
Yeah. No, this is the whole point. I mean, but there are other FANGs that are doing well. But you know what? This NVIDIA chart is not remotely as ugly. I mean, even this entire pullback over the last few days is still just approaching a 50% retracement of the last month's rally. So, this is not yet one that has broken its trend. And so you look at like a Google. And
1 second before you do Google, can we go back to NVIDIA?
Yeah,
I have a question for you.
Sure.
What do you think the odds are that gap gets filled before the end of the year? The big one.
I think it can. I think it's pretty good. I just think that it's not going to all happen here in September.
Granted,
it's. I think it's a later fourth quarter story. For instance,
think that we could see something with a 2 handle this year?
Yeah. And you know what? If you think about it, if NVIDIA, this is the crazy part, right? If NVIDIA goes and from its peak price. Lost 50% of its value, it would barely be a 50% retracement of the entire rally.
I know, it shows you how strong it's been.
Right? Like it's like a $300 is the fib retracement zone, right? And so the point is that there's so much room for this stock just to mean revert and still be ugly. But anyway, point is that
you wanted to talk about Google. I interrupted you.
No. But the Google is the one that's doing well. But actually, this price remains quite bullish. Higher highs, higher lows. Every dip's being bought. This is one of the ones that continues to be very well accumulated. But you take Microsoft, and that looks a little weaker. right? Like it could not muster up any meaningful, like it's been 2 weeks trying to retrace the last sell-off, and it barely has even approached the fib retracement zones. Like it's,
you know what? Why don't we keep going through all the 7 since you're doing this?
Yeah,
let's get
no.
so
Amazon.
important.
I think Amazon's one of the stronger looking charts. Even though it did gap fill, it's still actually poised to potentially go higher.
So wait, the gap fill meaning that the gap upward got filled, it went back down.
This kind of filled the earnings gap.
Okay,
not fully, but I mean, I would qualify that as being a gap fill. Okay. And so Amazon, I would say Google and Amazon are the stronger ones. And Netflix is no longer in the Magnificent Seven, is it? No, that's only that's a FANG, but I would say this one's much more neutral. I wouldn't be bearish. I think the price action on Apple and Microsoft are the ugliest.
Okay, you got to do Meta and Tesla.
Yeah. So like Tesla, this looks a lot like Microsoft, where it's like it had a very heavy sell-off and not a strong rally. And even then, they're trying to put out headlines of, new car, like the new Tesla orders out in Asia and things like this. And the stock isn't reacting to the headlines that typically would be interpreted bullishly, right? And then if you look at Meta, it's not a guy. I would say Google is by far the most bullish out of the Magnificent Seven. Okay. And Amazon probably is the second most reasonably good chart, but a few of these are getting very heavy. Maybe this is a testament of the weakness of Now, do you think, Kev, though, that we could have a scenario? Because obviously what happened was bonds crashed, right? Bonds got their asses handed to them, and all the bond proxies felt the pain. So all these defensive, high dividend paying things, this is the utilities, just had bond sympathy pain. Is that and even the healthcares like the XLV, just not we're stuck in the mud. Consumer staples.
But having said that, Patrick, the home builders, which you would assume would feel the pain from that, haven't. So it's a mixed bag. It's not easy.
No, but you know what?
Just saying.
But the home builders were and have been sort of like in a bizarro world because all these home builders out there are giving these huge incentives plans for people to buy, and no one can buy. It's much more challenging for people to move inventory in the secondary market because of mortgage rates. That they sort of got a huge influx, but that doesn't mean that they can sustain that. And so it'll be interesting to see at what point the home builders, start to feel the pain.
I'm not sure I buy that argument. Like, I get it. That's why inventory
I'm sorry,
is low.
You can't have freaking
at the end of the
real
day,
estate. You can't have mortgage rates at 23-year highs, and everyone's all, this is a great time to buy.
No,
like, give me
I just
a break.
think it's a function of the fiscal and the fact that everyone's balance sheet is in better shape.
Oh, God. I just puked a little bit in my mouth. I was trying to drink beer.
I know.
Like, no.
You go buy your bonds, buddy. Good luck.
Oh, but anyway, the question I had for you is this, right? So this is let's say consumer staples. There's been a few of them like that have been getting hammered, particularly like Colgate and Kraft and a bunch of these. But the question is, do you think we go back to that rotation where people go back to these, if let's say bonds bottom, which we can talk about bonds in a moment, and that part of the market stops having this big sell-off. Do you think people rotate out of the Magnificent Seven and go back into these defensive high dividend paying names rather than like a bear market? We just have a big ass sector rotation?
I want to say yes. And I want to say that would be the logical thing to do. But every time I say that, Patrick, I just see more and more people piling into like Mag 7 because they think it's a safety trade. And what if bonds don't end up kind of going up in terms of price and down in terms of yield as much as you
I actually don't think I don't think these bond proxy stocks need a bond rally. I just think that they need the bond market to stop going down.
Yeah, I could hear you. Like,
right?
I'm not disagreeing with you with that analysis. I'm just hesitant because it makes no sense to me, the Mag 7 and the obsession with just piling into these 7 stocks. And when I don't understand something, which I don't understand this, it leads me to say, yeah, you know what? It makes no sense. It could get even dumber. And that's what I'm worried about, is that it's so far past kind of logic that it doesn't, you're applying logic to it, saying, you know, it would make sense for you to move out of this.
No, but my pushback on that, the market has always defied logic. Rational thinking in the stock market has never been
I completely agree. And that's why I'm saying I'd almost rather just wait for like the charts to tell me, like, which is what you always say. And I'm with you that one of these days we're going to get the Mag 7 selling off and you might get all those other ones rallying. And I'll tell you when you'll know that it's come upon us is because instead of wanting to short the Mag 7, you'll be thinking that you want to buy it. That's going to be the point where you know that the correction has come, because it'll be like, oh, it's down a lot, I should buy these names. And it's always hardest. Like, it's easy to sell them on the way up because they're overpriced, and then on the way down it's hard to sell them because they're down and out versus where they used to be. Yeah. And to me, when I get that feeling where I want to buy the Mag 7 again, that's when I know that I'm going to that's when to really lean into it.
All right. Well, listen, I want to talk about the bonds then. This is the 10-year note, right? And we went and retested October low directly.
Okay.
And now there is no denying, and that, you know, I'm going to pull out a nice thick crayon to draw a nice channel. This is still distinctly a downtrend, and there is nothing bullish about this downtrend. So, but we are at a major support line, and I just personally will stand by my view that I just do not believe, when you look at where we are in the monetary cycle, credit cycle, the inflation cycle, every aspect of it, that this is not a time where I think the long bonds are going to rip to 5%. And that doesn't make me bullish, though.
The long bonds or the 10s?
Well, I'm talking about any longer duration, 10s to the 30s. Like, a point I'm making is that I just don't think that this is the stage in the cycle where we have another major leg down in bonds. And so one of the things I want to see is whether this previous low holds or not. And more importantly, do we see the turtle head formation where all these people that are watching these lows, whether we just have one quick dip below there just to run the stops and kind of fake everyone out and get every headline out there that bonds are at, multi-year high, yield highs. And then it turns around and whips the other way. And I think one of the things I want to just see is just draw this trend line. Are we going to see bonds kind of base and turn at some point in the month of September off of these lows? I think there's a good chance.
Do you know it's not going to happen? And do you know why?
Because you're long?
No, because are you kidding? I only have 3 positions for bonds.
Yeah.
Really short and flat. Okay.
Right. And so, you're flat.
No, I'm have somewhere between flat and really short, or somewhere between flat and short. But the point is that I'm probably the least short that I've been in a while. So I definitely think that we're headed a lot lower. There's no way I'm going to be right.
Well, no, listen. I think it'd be only going a lot lower if both of us were loaded long. I think the fact
that's true. That's a good point.
So right now, I think we're okay. What I wanted to just give an update just quickly on these junk bonds. I'm actually shocked how resilient, shitty, low-rated bonds, corporate bonds, have how they've dug in there in spite of the carnage in the treasury bond markets. Now, obviously, the carnage is in the long bonds, the kind of shorter duration, which is often what much of this junk debt is. Has not been where the pain is, but you would think the credit markets would be tighter and that it would force at least some sort of a premium on this stuff. But like when you look at where we are on the option adjusted credit spreads, we're still under 4%.
Yeah.
Like that blows my mind.
It's crazy, and it's just a function of maybe the economy isn't as bad as everyone thinks it is, Patrick.
Oh,
and everyone always talks about how the
God.
bond market's so smart, and yet here we go.
That is nonsense. Like I do not at all agree with you on that. Like I think it's one of these things that no one cares till everyone cares, and then they're all going to care all at once.
Dennis Garman line.
Yeah.
Yes. Listen, I'm with you. I'm at the very least, this is what I think about these. They seem like poor risk rewards from the long side. Like, what are you going to pick up?
Absolutely.
Go buy treasuries if you're
yeah. Like right now,
it doesn't make any sense to me. And
why would you go for a 8% yield on a shitty junk bond when you're gonna get a nice clean 4 or 5% on your treasury at this stage?
I tend to agree with you there. And but you know what? Credit's like STIs. Everyone thinks their credit is fine, and they're not going to be the problem.
Let's talk.
Everyone always they'll be like, oh no, I know. Like you'll hear bond traders or credit traders, they'll always be like, oh no, I think the world's going to end and the shit's going to hit the fan. But don't worry, this company's money good. It's always the same stuff. Everyone always says, listen, I do it. I had going into COVID, I had some stuff and I was like, oh no, mine are money good. Well, I'll tell you what, when the shit hit the fan, they all went no bid.
Yeah. Yeah, that's funny. Anyway, wanted to touch on these 210 curve here, and you can see that we obviously had some seriously steep inversions down at less than 1%. Slowly basing in here. It'll be really interesting to see when the market is going to start to actually bring this back towards zero. I don't know whether I'm not sure that the bottom is officially. I think the bottom is probably in here.
You know what your problem with this is? That you think the bonds are going to hang in there, like the longer end, and for this to change,
the Fed has to cut.
Yeah,
there has to be a bull steepener, and I think that's what's going to happen for sure.
Well, yeah, I don't know. So
I just don't. I don't think it's going to happen this year.
Like 200-300 basis points.
Not this year.
Don't forget, they have to cut more than what's in the market.
Yeah. No, I think they're going to cut, but I don't think it's. They're not going to cut this year, and the market's already pricing. I don't think that's going to be wrong. I mean, I don't know what would have to happen in the next kind of 3-4 months for the Fed to do an extraordinary pivot and shock the market. Shit would have to be hitting the fan pretty hard for them to start. But a 2024 story where the market has to realize that the Fed might be forced to cut more than everyone expected or is pricing in right now, I think that's a good chance for next year.
See, I think a better chance is that the market goes, holy shit, the Fed ain't going to cut like everyone expects. And that means that my 10-year pricing is wrong and that the 10-year fixes this inversion by going from 4 or whatever it is now to 5.5.
No,
I don't think it's going to happen now, like right away, but I think that that's a better chance than your scenario.
Yeah. No, I don't think it is.
Oh.
Well, that's what makes the market. All right. Let's touch on some of these commodities. Gold. Well, I don't know what to say about gold. It's been stuck in the mud. There's nothing bullish to say, but I'm not bearish either. So this is like in some sort of purgatory, waiting for a catalyst to start going.
Do you know what? Can I interrupt here for a second?
Yeah.
The best trade of the year, and I blew this. I should have done this. You should own gold and yen. Now I'm a yen bull, so I've been wrong that side. But if you go and price gold and yen, it's just been a steady uptrend with almost no dips. It's been the kind of a no-brainer. Can you do that? Are you able to do that on your chart?
Yeah. Well, I don't know. What do you want? I
Put
can
that
cross.
into yen.
Let me see here. What do we do? We'll just put.
So can you put the gold commodity? Yeah, you could do GLD and then you could divide it by JPY, US JPY or whatever.
There we go.
And it's just.
No.
Wait, did we go backwards? You got to go backwards. Sorry, times.
No, it's I'll do USD. No, we're making fools of ourselves here.
Yeah. It's okay. We do it on a regular basis. I don't know what the hell you're doing here.
I don't even forget.
You don't know
anyway,
how to drive.
I believe you. Clearly, we're fucking up the charts. All right. Well, anyway, the point is that I think gold will have its day, but I would not be shocked at this stage if we're waiting deep into the fourth quarter for this thing to wake up. The one thing that has woken up though is got to be crude oil. And the key here is that we broke out of to 2023 highs. All of these, this was the trade range basically for much of the year in this pocket, and we're now bullishly broken out above this. And I don't see much reason why oil can't get back to all of these highs that were in 2022 and the fib retracement zone, sort of like the mid 90s, maybe even as high as 100, but mid 90s, like 92 to 95 kind of zone. At this stage, the path of least resistance is for oil to keep going up here.
That beer coming up on you, Patrick.
No, this is a delicious beer, but. But anyway, the point though, oil's looking great, and that's one of the few things that is working right now in this market. And I think it's interesting. It's one of those things that could be where oil has a great bull run, and maybe it's oil that breaks the economy's back.
That's exactly what I was going to say. A lot of the great bull runs end with oil rallying. And then the Fed having to tighten against that inflation, and that's what crushes the economy. So that you might be spot on. Be careful what you wish for in terms of
long as I'm long tons of oil, then I won't complain.
Okay.
The last thing I wanted to touch on is we're drinking a little bit of Cuppy Kool-Aid and touch on uranium.
Oh my God, is he bullish?
Yes.
He's had the conference this week.
Yeah,
and he's just like he's foaming at the mouth, bullish. I think someone's got to make sure he doesn't have rabies. Anyways, listen, he's been spot on correct. He's been on fire. So you don't mess with the cup.
This has been the hottest commodity in the space, because like so many other things, the grains, copper, natural gas, everything's been stuck in the gutter and just getting chewed up in trade ranges. And uranium is just making fresh highs and running. Now the U308 contract, so the Sprott physical is already at a higher high, but it's priced in Canadian dollars. But when we look here, I'm just going to put a line chart on here on the U308, and we're almost at the 2022 high, which was near $64. And so if this breaks a fresh high, who knows? Are we going to see $70, $80 uranium? I mean, I know Cuppy would tell us a 3-figure number on that.
You'd be lucky if you only got 3 figures. He wasn't adding another digit.
But anyway, it certainly does look somewhat bullish here, and that's certainly something that's continued to work. You know what? It's so bullish, and there's so much froth. Like you were saying,
scared of it?
No, I just think that often these rallies get checked. And
I think it's a small market. That's one thing you need to remember as well, though.
Yeah, but I still think there's an opportunity for buying dips. Don't chase the rip. Wait for look at this chart. How many times you get these $2 pullbacks It's just the way these things trade. I think you have to wait for this thing to pause and mean revert for a new position.
Well, the only thing I will mention is that it is close to NAV. It's narrowed the discount. And I still think you love to buy these things when they're 10% NAV or 15.
Yeah, because then you got a little bit of a hedge inside of it, right? Yeah.
What else you got?
No, that's it. Like, is there something else you wanted to look at, or is that good?
I don't know. I just figured you'd have more to talk about. It's been a month.
I think this is pretty good. I think we'll leave it at that.
Okay, sounds good.
All right. So it's time to settle up skin in the game, Kev.
Oh, yeah. So I lost this one. And I just want to give shout out to you, Patrick, because I remember when we were discussing this, I wanted you to take what I wanted you to take up on oil. And then you said, nope, I'm only, if it's a month long, I'm going to take up. And then I said, what if it's 2 weeks long? And you said, well, then I'll take down. So you actually, either one, you would have won.
Yeah.
And you completely nailed it. And well, kudos to you.
Even a broken clock is right twice a day.
No. Listen, you're trying to be humble, but you really did. You nailed the oil market. You understood it. You did really well. I was going to lose that no matter what. And so it was a case of you winning. And so now the score is 40-49. And yes. I just want to take a chance, like a moment, to once again complain about the rules that we've accepted, and kudos to our listener that pushed us to increase the bet size. But now we're another month into it, and we got to do 5, if I understand correctly.
5,
right?
Yeah. Lena, 5. Come on here, clarify.
Yeah,
but
it's 5.
Yeah. So now we're up to 5.
4 in August.
So I picked away, got a nice lead, 40-49. I worked hard on this. And now I got to let him Hail Mary these bets at the end and potentially lose because of this bullshit rule.
I'm so happy.
It makes it more exciting.
Give me a chance.
I guess so. It makes it more exciting. But you realize that if you win 2 in a row from here, you're going to win the thing.
Yeah.
Like, which is just going to be bullshit. Like, it's just literally you're Doug fluting this thing. Yeah. And if you win it, it's going to be absolute bullshit. But anyways, that's it. I won't complain anymore.
You haven't lost yet. What?
Pardon?
You haven't lost yet.
You haven't lost yet, Kevin.
I know, but I'm still pissed that I can't just chip away at 1-1-1-1. But it does make for more exciting
you would bore our listeners.
I know. I would bore it. I would be like Iceman. Like Maverick was more fun to watch fly. But let's face it. If you're up in the sky, who would you rather have?
Goose.
Goose. Yeah, that does make sense. You would want Goose. Okay, so what do you got for? I got to tell everyone the rules, right? Let me just go and figure out the rules here. Where are we here? Okay, Skin of the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every second week, one of us presents a wager, and the other guy chooses which side of the bet he wants. It needs to settle by next episode. First person to 50 takes out 3 lucky or unlucky, as you depend on how you think about it. Market Huddle listeners for dinner, where they can grill him about why he made so many bad calls. And as we discussed, we have had this slight alteration in the rules to speed it along. We were doing 3 in July or June. No, was it June? No, 3 in July, 4 in August, and now it's 5 points every bet for September. Right. Okay, Patrick, what do you got for us?
You know what? I'm going to make it clean, simple, and raw for something that's sensitive to you. The 10-year note, 110. Jesus. We're going into the inflation numbers. We're going to see the FOMC before we record the next meeting. So we're going to have every catalyst higher or lower off 110 flat on the continuous, which is actually going to be the December contract.
So wait, what is the December contract? Pull it up just because
it is.
This is what I'm looking at?
We're because you're
100% sure.
Because it rolled back here in what's it called on the 1st. So this is now tracking the December contract.
So 110 up or down?
Up or down 110
for 5 points.
5 points.
You bugger. Well played. Well played. God. I'm going higher. I'm going to regret it, but I'm going higher.
Oh, damn.
I'm going higher.
Why would you do this to me?
No, I know, but you're going to win. Like, it's going to be dumb. I'm going to lose because I didn't go with my...
You're going higher.
Yep. I told you I'm not that bearish on bonds at these levels.
I shot myself in the foot.
Well, we'll see. It's like...
All right. All right. Well, let's see. There's
it will
someone's
be a fitting
taking
end if I win it on
a long bond call. Oh, that's actually, it's true. That if you are going to win it, that is actually a great way to win it. All right. So let's move on to No Stupid Questions. This is where Lena can come and save us.
It's been a while. We answered some questions.
Yeah,
it has actually, because I think we skipped them last time, right?
Yeah.
Skipped the last few times.
It's been a while. So,
Lazy.
All right, Lena.
All right. The first question here. Hello again. So obviously we've had this listener's question before. My question is about the pricing of options when the out-of-the-money calls are trading over equidistant out-of-the-money puts. Does this indicate the market or traders see risk to the upside for the underlying, and therefore it's a bullshit signal?
Okay, so...
Sorry.
No worries. So, I mean, this is all a skew thing. And the first thing that has to be accounted for is the interest rate differentials. And two is that puts, the second thing is that puts are naturally more, there's a steeper vol skew. Because it's the old adage, the markets rise on an escalator and drop on an elevator. The left tail is always more expensive, and so this is a natural thing that is that you have to take into account when trying to observe option market pricing. What would you say? You want to add to that?
Well, I think that's a great point, Patrick, in terms of that you need to examine what that skew typically is, and a lot of traders will basically normalize it. So let's say that on average it's 50, point half of a vol point, and then all of a sudden it's one vol point. That'll mean a much different kind of that's a better, cleaner signal than just looking at the price. But going back to your first point about interest rates, it's not just interest rates; it's also the borrow when we're talking about stocks, and it's specifically when you get into a situation with high borrow. The forward, meaning the price that these things are based on, that the options are based on, can be dramatically different. And you could see situations where in the old days with those SPACs, when you had like 400 or 500% borrow, you had the forward be like $10, like $10 on a $50 stock lower.
Yeah.
And it's really, really important that you put all those parts of it into the equation. So going and just looking at it and saying, oh, this one's $1, this one's 50 cents, so therefore people are bearish, that is a bullshit signal. You need to do a lot more work into it to really understand what's going on.
Yeah. All right, so let's go on, Lena.
Next question. Hi, Kevin, Patrick, and Lena. I stumbled on your interview with Vincent Deloitte a couple of days ago, which was awesome. I have a question regarding the USD/JPY carry trade mentioned on minute 12. I am wondering how the Treasury and foreign exchange... I'm wondering how the carry trade works by mismatching the durations between the Treasury and foreign exchange hedge. For example, how would an arbitrage make profit? By buying a 2-year U.S. Treasury and hedging the USD exposure via 1-year USD/JPY forward. The 1-year USD/JPY forward rate would reflect the current interest rate environment, and by hedging the second year of the Treasury duration via a 1-year forward would eat away the arbitrage in the interest rate spread, would it not? I read a lot about this trade, but just could not find an explanation how it actually works. Maybe you could bring some light to the dark corner of this trade. And by the way, I hope next year the Golden Mike Award by SHFMPA, Swiss Hedge Fund Manager Podcast Association, will be awarded to the best financial podcast out here. Was probably a close race this year. You certainly will get my vote. Many thanks.
Did you know that, Patrick? I didn't even know we were up for it.
Why? That's awesome.
I'm happy to do this one.
Yes.
I too am kind of shocked when I hear these people talk about, a Japanese investor buying a US 10-year can hedge it and the interest rate is this level. In an environment where all the risk is hedged, there is no ability to pick up any yield. And I just kind of want to repeat that again. Like if you went and bought a 2-year treasury as a Japanese investor and bought a 2-year U.S. Treasury and then hedged the actual foreign exchange, it should be that should be flat. And a lot of the times what they're talking about is buying a longer duration asset, hedging the currency for a year, and then taking your chances on hedging it again in another year's time. And I think it's kind of a ridiculous thing to talk about, but it seems to be something that they do, and it must be popular. But there is all sorts of yield curve risk with it embedded in that trade usually, or relative yield curve risk embedded in that trade when they talk about it. So you're not alone for wondering why this even exists and like why people talk about it. It is, in fact, not a riskless trade. And if it was a riskless trade, there would be no pickup.
Well, okay. I have nothing else to say to that. Lena, what's next?
Hey, Kevin, Patrick, and Lena. I'm a long-term listener and even longer-term longer-term reader of the macro tours. Sorry, I can't read today. I love to read and listen to both of you. Excellent job. Really appreciate. I was wondering if either of you have or look for long-term compounders to keep for the long term, a position that is bought and just kept for many years. This is an odd question for a macro trader and a technical trader. By definition, you are traders, and your identities imply that you're both traders at heart and not degenerate gamblers. We all know that we could have bought Apple or Nvidia, just to name two, 20 years ago and just kept them and made a killing. Hindsight is 20/20. I am not asking if you have the name of a stock that will multiply 20-fold in the next 10 years. We have Mr. Cooperman for that. I think he meant Cuffy, I'm assuming. All jokes aside, do you have long-term stock positions? And if so, what do you look for in a long-term compounder? High barriers to entry, few competitors, new technology, etc. Finally, a year or two ago, I sent a pair of about 50 stocks to Kevin. I was wondering if he ever got them. If not, well, I guess they got lost in the mail.
Oh,
I did get them, and I thanked this listener on one of the podcasts, but he must have missed that. And I do thank you very much for the socks. This is our friend from Montreal, from RBC DS Montreal. So thank you very much. I wear them all the time. People know that's true. I do. I love them. They're green, and they say Labatt 50 on them, and I just love them. And so thank you very much for the socks. In terms of, I'll answer this question about owning a long-term compounder in terms of a stock. I'm terrible at this. I can't do it. I remember way back when, Patrick, you're going to laugh at this story. When Tesla first came out, I think it was like way, like when it was $5. I sat and I said I think I even wrote this up in my letter, and I said, I don't know if this thing's going to do well or not, but it seems to be one of those stocks that, you buy for $5 or $10, and it's either going to be like 100 or it's going to be 0. So you should buy it. And then you know what happened, Patrick? I bought it at 5. It went to 7.5 or 8, and I got nervous about the market and I sold it. And so it's just not in my nature to buy and hold these things. And the things that I do buy and hold are more, I wouldn't call them compounders, but there's situations where I feel comfortable with owning it for the long term. Like, for example, I really like the Fairfax India trade. It's a closed-end fund. It's got a bunch of different companies in it. It's diversified. It's trading at a discount, and I can believe in the kind of the longer-term story. Yeah. So something like that, where I feel like I have a little bit of an edge in terms of valuation, and I understand it, I will hold for a long time. But I am not your guy when it comes to owning like a growth stock and sticking with it. How about you?
I've got a couple of stocks that I've still held for like 20 years. They were I used to love penny stocks back when I was a kid, and when they zeroed, they're still on my books. I can't get them off my sheets.
The worst thing in the world is when a company of yours goes bankrupt and you own like the debt or something. I have a couple of debt ones, and it just stares at you on your inventory all the time to remind you.
See, I'm a long-term investor,
What an idiot you are. Like, it's just the worst. Like, it's like
the shit I can't get it off my books.
Yeah. Well,
no, but
we should do? We should like sell it to each other so we can have something new to look at.
No, but you know what? I always try. Like, okay, I'm gonna let you guess what you think I would own over the longer term.
Bonds.
No.
What is it?
Gold and silver.
Oh, that's right.
But you know, like what happened to me is I had a nice. This is the downfall of option hedging. I had a long-term position on the SLV that I held for a long time. I'm not going to make up numbers. It's been on the books for a long time, and I overlaid the protective hedge, and I was dead right of when I put it on, and it hedged out the perfect thing. And I don't know why I wasn't fucking paying attention, but I took it into the thing, and it got assigned away, and I had to reset my cost base.
Oh.
Like, and so this is like, you have to, like, when you go and overlay these shorter dated hedges, you got to pay attention if you don't want to lose your underlying. So like, that was an idiot move of mine. Like, so now I can't say it was a long-term holding. Anyway.
Yeah, I don't think we're the right guys for that.
No. We
yeah.
I want to trade, and see, it's hard for me to buy and hold shit.
All right.
Yeah. All right. Anyway, that's it. Lena, where can people submit questions?
So if you have any questions for Kevin and Patrick, submit your questions to nostupidquestions@markethuddle.com.
All right. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give Lena a follow on Twitter or X or whatever it's called at the Market Huddle. I guess it's just at the Market Huddle. And you can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see our latest charts and visuals. And while you're there, please like and subscribe to get our latest content. Patrick, where can they find you?
You can follow me on X or Twitter or whatever it is at Patrick Ceresna. And you can also follow me at bigpicturetrading.com. Kev, where can they follow you, buddy?
You can go and check out my newsletter at themacrotourist.com. And listen, if you ever wanted a sample, please feel free to give me an email, kevin@themacrotourist.com. I'm happy to send you some. And you can come into our chat. You can go themacrotourist.com/chat, and you can join our group. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right.
We got to rate this beer.
Yeah, you first.
Well, I did have to negotiate the sponsorship, so I'm a little biased. That's a quality beer. 7.9.
You know what? I love this beer.
Oh, really?
No, I really do. It drinks super crisp, clean.
It does. Doesn't it feel Canadian? Like we must have copied them or whatever. It just feels the same.
It's absolutely delicious. Actually, I'm going to give it a 8.7. This is a great beer. Yeah. No, this is a great beer. I would drink this all the time if I could get it. This is I really like this beer, and gets my vote.
Gets your vote. That's good. All right, Lena, let's get you into the conversation here. What have you been up to?
We were in Croatia last week, and now I'm in this
Party time.
You were in Croatia.
Yeah.
Yeah.
What were you doing there?
I was on a boat.
And a boat.
I was on a boat.
You were practicing your Saturday Night Live skit?
Yeah.
I'm on a boat.
Oh, we cranked that.
Not gonna lie, every day.
Oh, did you really?
Every day. Yeah, everybody was having, wherever we would stop, everybody's having a really nice, quiet, they're enjoying the view from their boats and stuff. And we show up, we're just cranking music.
You degen show up.
Yeah.
So, who was captaining the boat?
Captain Tom.
Okay, so Captain Tom, did he live with was his wife on the boat? Sometimes you get a husband and wife team.
No.
No. I think Captain Tom had a lady at every port. I think that's how he put it.
He's like a NBA basketball player.
Yeah.
Oh gosh. Okay, so and did Captain Tom cook for you as well?
Oh no.
Oh, like you were on your own for cooking.
Oh yeah.
Oh yeah.
He just got you from place to place. Hopefully, like
safely. Yes.
And would he sail during the day? Like how long was the sailing?
Yeah, we'd go. Basically, we were on the move majority of the day, and then we would dock or anchor somewhere for overnight. So that was very interesting.
Wow, and you degens, like there must have been a lot of drinking going on.
Ridiculous.
Oh, we looked like raging alcoholics when we were getting onto the boat and getting off the boat with all the empties.
Luckily, no one got hurt or drowned. But
And what was your favorite place?
Me?
Yeah, or Patrick too, both of you.
Probably when we went to Party Island.
What?
oh, Flower. She liked the Flower Island.
What is it?
No,
Let me
but,
Google this. How do I spell it?
HVAR.
HVAR Island.
So there's a main island, but
Yeah.
to get to the nightclub itself is on its own island, and so you take a ferry to just get to the nightclub.
Okay.
And
You need
it's
to be on the boat to get off the island. So it's
and
What's this nightclub
and
called?
the nightclub doesn't
was it called?
open
Carpe
until
Diem, I think.
Carpe Diem, like the movie.
Yeah.
Oh, there it is,
God.
beach bar.
yeah.
And
And the place doesn't even open till midnight, and it goes till 5 a.m. Like they know how to party over there.
I mean,
That's
there were lots of beautiful places, and of course,
No,
I
my-
mean, this
my favorite
great
was Vis.
Yeah, Vis was really
Okay, how do I
nice,
spell that?
beautiful.
VIS.
VIS.
Vis, Croatia.
But the Party Island is only because Patrick was there with
Oh
us.
no.
Spell the guts.
Well, I mean, he's already
The-
told you, it opens at midnight and ends at 5. That's all you need to know.
So Patrick opened and closed it.
So
I can't say no. I can't say anymore.
yeah. So Kev, you made it across the country, eh? Yeah.
Well,
you
I went the other way
to
this time.
yeah.
Went to Halifax to drop a kid off at school. Yeah, so it was pretty exciting. Lovely
How-
town.
how was it
Actually,
out
I'm
there?
a huge fan. I
yeah.
never spent any, like I love Nova Scotia. I never spent any time in Halifax, and so I spent a little bit of time there, and it's awesome. And I was laughing with a buddy saying that the youth. I'm sorry, being young is really wasted on the youth. like to be 19 years old or 18 years old and going to school again. Jeez, looks like a lot of fun.
Well, you know what? The summer's over though, buddy, and we have to
get to work.
You have to get to work.
Well, you know, everyone, it seems like this week, even though you'd think that it was summer was over, it felt really quiet still. And I was talking to
Really?
somebody, and they were telling me that their kid in New York City wasn't really going to school till Thursday. So I think that even though we think that it was, after Labor Day, everyone's back at school, it's normal, it'll really be this upcoming week that is more back to normal.
Yeah.
That's my feeling.
Yeah, that I'll agree with. Like, I think actually like this week was like everyone's sort of getting a feel for everything, but I think the inflation numbers next week will really be when everyone's back at the desk, and that's where the volumes will really start getting whipped around again.
I completely concur, Patrick. And I remember back in my day when I was on the sell side, and we'd be sitting there just starved for business, waiting for the summer to end and for everyone to come back in September. And then we'd phone up the people and we'd say, look, what's going on? And they'd be like, we're in meetings deciding what to do still in that first week. So it wasn't really till the second week that we got any real orders to do anything, because everyone was off for the summer, and then it took them a week to decide. I don't know if that's still the case, but that's how it was.
Yeah, and this is why it's so important to watch, because we're just showing on the charts where the S&P is and the Nasdaq, and the way some of these FANG stocks are getting heavy. I think that it's going to be a real big tell next week which way the market breaks.
You know what? We're really screwing up the after hours here. I like, what are we doing? We're talking about markets.
Yeah.
We better just call it a day.
We better call it quits.
Okay. Thanks for tuning in, everyone. We'll see you in a couple of weeks.
All right. Cheers.